Hello and welcome to another episode of ETF 360. I'm Kirsten Chang, Senior Industry Analyst at VettaFi, and today I'm pleased to be joined by Aram Babikian, Head of Xtrackers Wealth, U.S. onshore for DWS. Aram, great to have you. Thanks so much for joining us.
Hi, Kirsten. Thank you for having me.
Absolutely. No shortage of timely topics to get to, but first, why don't you just start briefly by telling us a little more about DWS and Xtrackers?
Sure. So DWS is a $1 trillion global asset manager. We have offices in over 20 cities, managing $1 trillion across various different asset classes, including alternatives, active fixed income, and equity. And our Xtrackers is the ETF division of DWS. DWS has about $365 billion across the entire Xtrackers platform globally, with $27 billion here in the United States across 40 different products. And our products are pretty unique. We like to create products that follow our three principles, which is innovation, access, and value. When we're coming out with ETFs, we're looking for products that are the most innovative, that provide access to markets that investors might not necessarily have access to, and value at a highly competitive price point.
Great. So I want to ask about geopolitics right off the bat, because obviously global geopolitical tensions and risk have been rising by the day. You've got Russia, Ukraine, tensions in the Middle East, trade wars, etc. How should investors kind of factor these exposures into their portfolios? I know you have a fund that hones in on that narrative a bit.
Yes, exactly. When we were thinking about our product lineup and we were making additions to our thematic category, we were approached by Solactive, which is one of the most innovative index providers, and a company called J.H. Whitney. J.H. Whitney is a defense contracting firm and a data analytics firm. They created a very unique algorithm and have a very unique view on the overall markets. But essentially, what that meeting showed us was, in terms of what's available in the marketplace right now, of how you can potentially de-risk your portfolio for geopolitics, there are very few solutions. Either you're going into very different asset classes, you're going into gold or Bitcoin, or you're de-risking going into cash, or you're doing something different. But there wasn't necessarily a solution of this kind and this magnitude that allows you to stay invested within the equity asset class, but simultaneously also de-risking your portfolio for geopolitics. So we're partnering up with Solactive, J.H. Whitney. Xtrackers by DWS came out with an ETF called the U.S. National Critical Technology ETF, ticker symbol CRTC. Back in 2022, the Department of Defense identified 14 critical technologies that were essential for strengthening America's national interests to improve technological dominance as well as protect national security. And along those lines, you have AI, you have quantum computing, you have biotech, you have semiconductors. But, that's one side of the aspect of this particular ETF. But the other side is, we saw in the past 20 years a pattern of globalization when it came to a lot of these companies. And these companies dove headfirst into growth through globalization. But we know that geopolitics is not linear in fashion. And as a result, over the years, things have changed from a geopolitical standpoint, from global trading order. You have different leaders in place that have different policies. And as you mentioned before, geopolitical tension has risen quite a bit. In fact, it might be one of the most volatile, at least in my lifetime, that I remember. And well, what do you do now to de-risk your portfolio? So this is where the algorithm that J.H. Whitney developed comes in, where we have a geostrategic risk rating that looks at companies and their entanglement risk with adversarial nations like China, Russia, Iran, or North Korea, and de-risks your portfolio by taking those companies out of the portfolio on a dynamic basis. And if those companies do improve their situation, they actually get put into the portfolio. And we saw this product do quite well in the beginning of the year when geopolitical tensions were rising quite a bit.
Yeah, no, that's a great point. Want to ask a little bit about international more broadly, because for years we've been saying this is the year international equities will be making a comeback, right? Seems like it's finally happening, bit by bit. June was a record month for international equity ETF flows. So we'll get to your fund in a minute, but what's behind this momentum, you think?
Well, I mean, there's a lot of changes, and I would say in this regard, it's a lot to do with the Trump administration. The current policies in place are creating a very unique scenario where it's forcing the international community to be a lot more self-reliant. In Europe in particular, and we like to believe as DWS being truly a global firm, we are one of the gateways to Europe, and we're helping all of our investors connect the dots there. But within the international space, and like I said, in Europe, you're actually seeing a seismic shift. And I hate using that cliche of this time it's different, but it is. And it is because it's actually fundamentally different from a structural standpoint, from a paradigm shifting standpoint, where this $1 trillion that's the stimulus package that Germany put forth. Germany is the largest GDP economy in all of Europe. And a $1 trillion stimulus package, nothing like this has been put forth or even close to coming for within that space since 1945. So you're talking about a massive stimulus package, but the size of it is also something to take into context. Germany at any given point in time is about a $4 trillion GDP economy, 4 to 6. But you compare that to the U.S., the U.S. is a $24 trillion economy. So $1 trillion into a $4 trillion economy is $6 trillion into $24 trillion. We've never done that before here in the U.S. So the sheer size of this is something worth considering. But also you have the discount in PE ratios relative to the U.S. that is still very attractive. So you're talking about value, but also these governments now investing within their own economies in defense and infrastructure, which makes things very attractive. Plus, again, from a structural standpoint, you did see shifts in the Constitution. You did see shifts in debt limits. These are all structural changes where really this time it is different.
Now, you have two funds that focus on international, one that's currency hedged and one that isn't. Seems like unhedged is kind of the way to be right now, but talk to us about the key differences there.
So when I came to DWS, for me, one of the beliefs that I had that I realized was a bit incorrect was that currencies add value and diversification when you're investing it. Our team, headed up by Rob Bush and Jason Chen, actually have done quite a lot of research, and the blog is available on our website. But they have made the discovery that currencies don't necessarily add value to your portfolio. Instead, they are uncompensated risk. So with that, uncompensated risk equals increased volatility. So the reason why you go currency hedged is actually a way of investing internationally with decreased volatility. And if you're a U.S. investor, you're just bringing it back to U.S. dollars. What you don't realize with going long currencies is you're creating a levered bet scenario where you're going long 100% the currency, but also 100% long the underlying company. So the past 10 years, you've actually been paid to hedge, where there's a differential between the interest rates in the U.S. and internationally. So you had a positive carry. Now, obviously, that can change at any given point in time, but that positive carry is the reason why you would do currency hedge. Right now, though, there's a very unique scenario where you're seeing a weaker dollar. And in fact, it's been one of the greatest moves from the standpoint of the dollar weakening since the Nixon administration. And with that being said, we don't know how long that's going to be. So we do have a unhedged version in HDEF, which is also at only 9 basis points. And that is following the MSCI EFA index unhedged, but also looking at quality companies and quality dividends. While DBEF is our currency hedge version of that, we are actually seeing a lot of advisors do a 50-50 split right now because they don't know when the reversal is going to be if the dollar does strengthen. But at the end of the day, they want to be able to kind of enjoy both sides right now.
Makes sense. And I want to end on AI because you have an AI fund. How should investors look at opportunities there? Should the focus be more on the companies driving the innovation or more on companies that are applying AI in their operations?
So our ETF XAIX is a very unique product here where it actually uses parts of AI, natural language processing, via NASDAQ's unique approach of analyzing various patents that companies are holding. So we're not looking at just companies that are driving AI innovation or architects of AI, but also ones that are going to be beneficiaries of AI. It's not just your companies that make your chips and things of that sort, but AI is going to be implemented all throughout. It's like Internet 2.0. Every single company in the world is using the internet. And it seems that AI is going to be in a very similar fashion and a mass efficiency tool that's going to be used all throughout. And the companies that embrace them early are going to be one of the greater beneficiaries.
All right, that does it for ETF 360. My thanks again to Aram Babikian for joining us, and thank you all for tuning in. We'll see you next time right here on ETF 360.
Thank you so much for having me.